Okay, let's take a look at some in-class problems for Chapter 20. Before we do that, I want to show you this the flow of manufacturing activity cost summary. So here are our three inventory accounts. Goods in process is also known as work in process. Okay? The raw materials account is keeping track of the cost of raw materials that were purchased, ready for use in production. As materials are used in production, they're taken out of raw materials and recorded into goods in process. In addition to material cost, as we're making inventory, the goods in process or work in process account is increased by actual direct labor cost. So actual direct materials, actual direct labor. The overhead cost or the manufacturing indirect cost. As we are making the inventory, we do not know what our actual overhead costs will be. So the amount that we record here into goods in process, this needs to be an estimate. It's called allocated overhead. When we allocate overhead, we are recording an estimate in here. We debit work in process or goods in process, and we credit an account called factory or manufacturing overhead. Okay? Debit goods in process, work in process, credit overhead for the amount of the estimate. The way we come up with that estimate is by using a predetermined overhead rate based on a cost driver. The predetermined overhead rate is the total estimated manufacturing overhead cost that we anticipate and divide by some type of estimated cost driver activity. Here in this example, they're showing us that direct labor costs are the driver of the indirect cost. The predetermined overhead rate is calculated by taking the total estimated overhead divided by the total estimated cost driver. That calculates a predetermined overhead rate. Using that predetermined overhead rate, we multiply it by the actual cost driver to come up with the estimate, the allocated overhead we will debit into goods in process and credit into our manufacturing overhead or factory overhead account. If the estimate or allocated overhead is greater than the actual overhead incurred during the period, we will be over allocated or over applied. However, if our actual overhead costs are greater than our estimate, we will be under applied. Over applied, we allocated or applied too much of an estimate. Under applied means our actuals were less than our estimate. Okay, let's apply those concepts to some in-class problems. Raw materials purchased on account. We will debit raw materials for the materials that will be used in production and credit accounts payable. Factory labor accrued. This is the factory labor working on making the product. Direct labor is debited into work in process, and accrued typically means we haven't paid for it yet. We will pay it, so we will credit wages payable. The key here is to note that work in process is debited for our actual direct labor cost. Incurred manufacturing overhead on account. Incurred tells us that this is actual manufacturing overhead. So we will debit manufacturing overhead and credit accounts payable. Okay. So we're seeing some of the journal entries that are recording costs into those inventory accounts as we are working on them. Okay. Remember, this manufacturing overhead account is that clearing account, and that clearing account is helping us keep track of the actuals by debiting that account for actual indirect costs, and that account would be credited for our estimates or our allocations. So let's talk about the estimate or the allocation of overhead. Washburn Company produces earbuds. For the year, $242,000 in manufacturing overhead costs are estimated, and estimated machine usage is 2,600 hours. To calculate the predetermined overhead rate, we will be taking the total estimated manufacturing overhead. Okay, and let me even clarify this and say estimated and estimated, because remember the predetermined overhead rate is calculated using estimates. When I divide my total estimated overhead cost, 242, by my total estimated cost driver activity, 2,600 hours. 242 divided by 2,600 gives me a predetermined overhead rate of $93.08 per machine hour. Okay. Notice that the overhead rate is calculated using estimates. Okay. Now let's take that a step further. We now have the predetermined overhead rate calculated. Now let's determine the amount of overhead to allocate to one particular inventory item, which they're calling job number 551. Okay. Job number 551 actually used 90 machine hours. The predetermined overhead rate tells us that for every machine hour incurred, that inventory or that job should be allocated $93.08. This job used actual machine hours of 90. To allocate my overhead or applied or allocated overhead rate, we are going to multiply our predetermined overhead rate, which we just calculated at $93.08 per machine hour. We are going to multiply that by the actual number of the cost driver. Actual machine hours were 90. Predetermined overhead rate times the actual machine hours, $8,377 would be the amount of overhead that I would allocate to job 551. Okay. Now let's prepare the journal entry to assign or allocate the overhead to that job. We need to allocate $8,377. Our journal entry to allocate is to debit work in process. That's where the estimate is debited into, and we are crediting the manufacturing overhead account. Okay, here is this clearing account. It gets credited for our estimates as they are recorded into work in process, and it is debited, like we did in the previous problem, for our actual overhead cost. Okay. Continuing on with another problem to continue working with that manufacturing overhead. Banks Company applies manufacturing overhead to jobs on the basis of machine hours used. Machine hours used is their cost driver activity. Overhead costs are estimated to be $280 for the year, and machine usage is estimated at 125,000 hours. Calculate the predetermined overhead rate. We need to divide the total estimated overhead by the total estimated activity. Total estimated overhead divided by 125,000 machine hours gives us a predetermined overhead rate of $2.24 per machine hour. That is the manufacturing overhead rate, or the predetermined overhead rate. Now we are going to figure out at the end of the year whether we were under or over applied. If we had a predetermined overhead rate of $2.24 per machine hour, as we go through the year and inventory incurs or uses machine hours, we will be allocating $2.24. If during the year 130,000 hours are used, it means that we would have allocated or applied an estimate of $2.24 times 130,000 machine hours. We would have allocated a total of 224 times 130,000. Oops. Let me get the calculator working here. 130,000 hours. We would have allocated or applied $291,200 by debiting work in process and crediting manufacturing overhead. Then, if we compare our actual overhead costs for the year to the amount that we applied for our estimate, actual overhead costs debited into manufacturing overhead were $295. The estimate credited into manufacturing overhead was $291.2. We ended up $3,800 difference. We are underapplied because our actual overhead or indirect costs were greater than our estimate that we applied within work in process. That means we were underapplied. We didn't apply enough overhead. We didn't record enough of an estimate. Okay. Now that we have really spent a couple problems focusing in on that manufacturing overhead, looking at how we calculate the predetermined overhead rate and how we use that predetermined overhead rate to calculate and record an estimate, and comparing that estimate to our actual overhead cost. Now let's take a look at a little bit bigger picture here. All of those product costs combined. Remember, product costs include direct materials, direct labor, and overhead. Dill Company begins operations on April 1st. Information from job cost sheets show the following. Okay? Job cost sheets are a document, or nowadays a digital record, of each job and the cost incurred as it's being manufactured. So think of this as like a little side subsidiary ledger. Okay? It is keeping track of the details outside of the general ledger, keeping track of costs as they are incurred. And these job cost sheets help us as we're preparing journal entries into the general ledger. Okay? So here it looks like this company had 5 jobs that they were working on during, it looks like month of April, May, and June. Job number 12 was completed in April. So it looks like all the costs were incurred and it was completed during April. Jobs 11 and 13 were completed in June. So job 11 was started in April, completed in June. These were the costs incurred over those 3 months. Job 13 had costs incurred in May and June and was completed in June. Each job was sold for 25% above its cost a month after it was completed. We first need to figure out what is the balance in work in process inventory at the end of each month. Remember, work in process is keeping track of the cost of the inventory as it is being worked on. It's inventory that is not yet complete. Let's talk about April first. The balance of work in process at the end of April will consist of the jobs that were not completed as of the end of April. In April, we were working on 3 jobs, 10, 11, and 12. Of those 3 jobs, 2 of them were not completed at the end of April, but 1 was completed, which means at the end of April, the only cost recorded and still sitting in work in process will be associated with jobs that were started, not completed. There were only 2 jobs started that were incomplete at the end of April, jobs 10 and 11. So for the April 30th work in process balance, it will be the cost incurred thus far on job 10 and 11. Okay. The costs incurred on job 10 and 11 were $5,600 and $4,100. At the end of May, we had job 11 still in process, job 13 still in process, and job 14 still in process. Total cost of work in process will be the cost incurred thus far on those 3 jobs. Total of, let's see, the cost incurred thus far on jobs still being worked on, job 11, $8,000. Job 13, total cost incurred at the end of May of $4,700. And job 14, total cost incurred of $5,400. Total cost overall of work in process the end of May of $18,100. Work in process at the end of June will consist of only 1 job. Actually, let's see. Yeah, 1 job. We had job 11 was completed in June. Job 13 was completed in June. Job 14 was not complete. So at the end of June, we have a total of $9,000 sitting in work in process associated with the job 14. What is the balance in finished goods at the end of each month? Remember, finished goods is keeping track of the cost of jobs that are finished and ready for sale. At the end of April, we only had 1 job that was completed in April. When the job was completed, those costs were transferred out of work in process and into finished goods, which means at the end of April, the $1,200 associated with the only completed job, job 12 of $1,200, is the balance in finished goods. At the end of May, finished goods will be comprised of jobs that were ready for sale but not sold. If each job is sold in the month following completion, that means that job 12 that was completed in April was sold in May. So it is not still sitting in inventory. In May, they only had 1 job that was completed and ready for sale. Job number 10. Total costs associated with job number 10 are $5,600 plus $4,400. Total of $10,000 sitting in finished goods. Finally, for the month of June, finished goods will be comprised of jobs completed but not sold. In June, it looks like we had 2 jobs. Job 11, total costs associated with job 11 are $4,100 plus $3,900 plus $3,000. Total of, what's that, $10,000? $11,000. And then we had job 13, total cost of $9,000. Total cost, sitting and finished goods at the end of June, $20,000 associated with 2 jobs. Finally, they want to know what the gross profit is for May, June, and July. Remember, gross profit is going to be the cost, the difference essentially between the cost incurred to manufacture and the amount it was sold for. If each job was sold for 25% above its cost. In May, we sold, it looks like we would have sold the jobs completed during April. So if we completed job 12 in April, it was sold in May. The cost of that job was $1,200. It was sold for 25% higher. So 1,200 times 125% means it was sold for $1,500. Sold for $1,500, had a cost of $1,200, had a gross profit of $300. During June, we would have sold jobs completed in May. In May, we completed 1 job. It cost us $10,000. If we sold it for 25% more, we would have sold it for 125% of its cost. We would have sold it for $12,500, giving us a gross profit of $2,500. And finally, in June, we would have sold, actually in July, we would have sold the jobs completed during June. During June, we completed job 11, total cost of, $11,000, and job 13 at a total cost of $9,000, total cost of $20,000. We would have sold it for 25% more. 25, whoops, sorry about that. Let me get back to this thing. 20,000 sold at 125% or 25% higher, 125, 1.25. We would have sold it for 25,000 for a gross profit of 5,000. Okay, hopefully that all makes sense. Now notice that here, all of these costs I mentioned came off of job cost sheet. Here, the next problem, we can see what a job cost sheet might look like. Nowadays, all of this would be kept electronically or digitally, but if this was a hard copy document, this is kind of what it would look like. This is one particular job, and we are seeing the direct materials, the direct labor and overhead costs that are incurred. As those costs are incurred on specific dates, the job cost sheet is keeping track of those costs. So these costs are being recorded as they are being incurred and that job's being worked on. Remember, these job cost sheets are like a side document or a subsidiary ledger outside of the general ledger. Okay? We use this to help us record into the general ledger. Okay? So where do the amounts come from that are recorded into a job cost sheet? That is actually the first question in this problem. The types of documents where this information comes from would be from material requisitions. As a company calls materials into production, they create a requisition. They're requisitioning materials into the production process. Those material requisition documents would tell us the amount of materials that are being incurred on that job. Labor costs would come from employee time tickets, right? Or time stamps as they're working on the job. And then the manufacturing overhead cost would come from our calculations of using the predetermined overhead rate, multiplying it by the actual cost driver. Okay, so a little information here. This is Nielsen Company. Information about a particular job that they're working on. Direct labor costs are the cost driver here. In other words, the direct labor costs are what are the cost driver causing this job to incur overhead costs or indirect costs. So we can figure out what the predetermined overhead rate must have been by doing this a little backwards. Instead of using the predetermined overhead rate, multiplying it by direct labor cost to get to the amount of estimated overhead applied, we're going to work backwards because they gave us the applied overhead and the amount of the actual cost driver. We're going to work backwards to figure out what the predetermined overhead rate must have been. Okay. So here, they're helping us with the math. We can figure out that the predetermined overhead rate must have been 125% of direct labor cost. How do I know that? Well, if the amount of overhead applied on the 15th of July was $550, and that was applied based on the amount of direct labor cost incurred. If I divide 550 by 440, I get 1.25 or 125%. In other words, I used the $440 in overhead cost multiplied by the predetermined overhead rate to get the amount of overhead applied. The same thing would occur here. Total estimated overhead was total applied overhead was 475. Divide by 380 actual direct labor dollars or costs, there's that overhead rate again. Overhead was applied by multiplying actual direct labor times the predetermined overhead rate to get my applied overhead. Okay, so they had us work backwards to figure out what the predetermined overhead rate must have been. Okay, we would do the same thing for this application of estimated overhead. The last thing they want us to do is come up with the total cost and the unit cost of the completed job. Total cost is going to consist of all of the direct material cost incurred on this job, total amount of direct labor incurred on this job, and total manufacturing overhead incurred on this job. Adding up all of those amounts, if I were to add up 825, 900, 1600, and 1500, total materials costs incurred on that job were $48.25. Direct labor, adding those up, I would get a total of $13.60. Total estimated overhead recorded for that job, $1,700. Total cost of that completed job, $78.85. To come up with the unit cost, I need to focus on the fact that 2,000 units of the inventory were manufactured on this particular job. If I take the total cost of $78.85 and divide by the total number of units, I come up with a manufacturing cost of $3.94 for every unit manufactured. Okay, let's continue working with these concepts. Pedro Associates is a CPA firm. They are using this job order costing to capture the cost of its audit jobs. There were no audit jobs in process at the beginning of the month. And then this is the data for 3 audit jobs that were completed during the month. Okay, what this problem is doing is it's working with the same concepts, but we are looking at it from the perspective of this is not manufacturing inventory. This is providing a service. But these concepts work for both a manufacturing environment and a service company. Okay, so the first thing they want us to do is determine the cost of each of these jobs. They have given us the direct materials for each of these audit jobs, the labor costs incurred for each of those jobs, and the hours incurred to audit each of those jobs. Overhead costs are applied to jobs on the basis of audit hours. So the cost driver is audit hours. The predetermined overhead rate, already calculated for us, is $55 per audit hour. The Gonzalez job is the only incomplete job at the end of November. So these 2 jobs were completed. This one is incomplete. Actual overhead costs incurred for the month was $12,000. Determining the cost of each job. We will be taking each job's direct materials, actual labor cost. Okay, all of that came straight out of the problem here. Then to come up with the applied or the estimated overhead, we will multiply our predetermined overhead rate of $55 times our actual hours. Because the driver was audit hours, we multiply the rate times the audit hours. If I multiply $55 times 72, I come up with $39.60. 88 times 55, I come up with $48.40. 45 hours times $55 per hour, $24.75. I now have the total cost of each job. The only job that was in process at the end of November was the Gonzalez job. So work in process at the end of November will be the cost associated with the job still in process. They also want us to calculate the ending balance in the manufacturing overhead account. Remember, the manufacturing overhead account is debited for our actual overhead costs during the month, and it is credited for the amount applied, which means adding up the amount applied. Adding those together, I get $11,275. That would have been credited into the overhead account. My actual overhead debited into manufacturing overhead was $12,000. If I debited overhead for $12,000 and credited applied overhead, I ended up with a debit balance of $725, which means I underapplied because my applied overhead was less than my actuals. Okay, one last problem to get this solidified in our head. Elliott Manufacturing uses job order cost system. Manufacturing overhead is applied on the basis of direct labor cost in Department A, direct labor hours in Department B, and machine hours in Department C. So they have identified 3 different cost drivers, a different cost driver in each department. They're establishing the predetermined overhead rates for 2010, and we have the following estimates. Total estimated manufacturing overhead by department, total estimated direct labor costs by department, total estimated direct labor hours by department, total estimated machine hours by department. In January, job cost sheets showed the following cost and production data. Here are actual costs for those 3 departments. Okay. We are going to, and that's really small, we're going to compute the predetermined overhead rate for each department. Remember, predetermined overhead rate is calculated by taking the total estimated overhead divided by the total estimated cost driver. For Department A, the cost driver is direct labor cost. So I take the total estimated overhead divided by the total estimated cost driver. If I divide dollars by dollars, I end up with a percentage. Predetermined overhead rate for Department A, 130% of direct labor cost. Department B, cost driver is direct labor hours instead of dollars. Total estimated overhead for Department B divided by total estimated labor hours. Dollars divided by hours gives me a predetermined overhead rate of $16 per direct labor hour. Department C, machine hours is the cost driver activity. Total estimated overhead divided by total estimated machine hours, $5 per machine hour. Okay. Now that we have the predetermined overhead rate, we are going to assign or allocate the amount for each department during the month of January. Okay. In Department A, total cost incurred will be the direct materials, the direct labor, and then the amount of overhead that is applied. Department A, overhead is applied at 130% of direct labor cost. Direct labor costs were $48,000 times 130% will give me overhead of $62,400. Total manufacturing costs in Department A of $2,024. Department B, direct material cost actual, direct labor cost actual, and then Department B is allocated overhead based on $16 per direct labor hour. $16 times actual direct labor hours of 3,500 gives me overhead applied of 56,000. Total direct materials, total direct labor, total overhead applied, 177,000 total manufacturing cost. For Department C, total material cost, total direct labor cost, along with the allocation of $5 per machine hour for overhead. Machine hours in Department C were 12,600 times our predetermined overhead rate of $5 per machine hour gives me overhead applied of 63,000. Total manufacturing overhead cost of 177,400. The last thing they want us to do is compute the under or over applied overhead for each department. Remember, under or over applied overhead is going to be calculated by taking the difference of the actual overhead incurred for each department compared to the amount applied. Here is the amount that we applied for each department. Compare the actuals to the applied. A, we incurred more than we applied, so we are under applied. B, we incurred more overhead costs than we applied. Again, we are under applied. In C, we incurred less than what we applied, thus we are over applied. Okay, hopefully this helps. Please let me know if you have any questions.